Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. Go to focuscompounding.com to get access to investment write-ups from Geoff going all the way back to 2005. And of course, if you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. So in the last podcast that we recorded, we briefly discussed this question that somebody had sent in, but I thought it would be good to dedicate an actual full-on podcast to it since we spoke a lot about movies and the movie industry in the previous podcast. If you want to send in a question, send it in. Email me, andrew@focusedcompounding.com. We'll pull them, put them on the screen just like right here, and we'll talk about them on the podcast. Somebody asked, could Geoff discuss how he thinks about optimal capital structure, specifically for microcap names that may or may not have access to investment grade credit? In addition, how would he think about debt deleveraging stories that offer more upside via leverage when compared to some, in quote, higher quality names within the same industry? How much credit and valuation does he give or not give when something is highly leveraged and he likes it versus unleveraged and he doesn't like it, but it might not change and everything in between? Feel free to take that in any direction.
Okay.
So all about leverage.
Yeah, so this is a very complicated subject because I think when I talk on the podcast, people think that I'm really against debt. And there's a few parts to that. One, and Ben Graham, I think, said this in the interpretation of financial statements, I think. But basically, any company that has net cash has to be worth more than it would be if it had net debt. And any company with net debt has to be worth less than it would be if it, had net cash, right? So in other words, whether we always talk about in terms of enterprise value instead of market cap or something, what he was saying is we can apply some sort of idea that if they're piling up cash, they might never get good use. But you should not ding a company to say the fact that they have a lot of net cash and haven't done anything with it, it means that they're stupid. And so I'm going to apply that they deserve like a lower PE or something. On the other side, sometimes people say, oh, look how smart they are that they're using leverage. I'm going to think that it should be even higher. My feelings about management and kind of the multiples I should put on it. So I think in terms of absent anything else about what our feelings are about it, it is better to have cash than to have debt just in terms of the valuation, and you need to incorporate that into it. Having said that, having debt and doing smart things with it, like say, I think Nathan's, which was maybe Microcap at the time, borrowed and paid out a special dividend. I think that there have been ones that have borrowed and bought back a lot of stock. So that can make a lot of sense. Nathan's, outside of COVID, was a very, very predictable sort of business. Now, my guess on that actually is that and I could be totally wrong about this, there was someone associated with Nathan's on the board and everything that had a history with other companies that had used a lot of leverage, and which it's more traditional to use leverage in those things that are bigger companies. So my guess is that may have kind of influenced things. You see this more often with like private equity firms that maintain some stake in a company that's been public for a while. Sometimes they kind of recapitalize them instead of having some other exit, right? Instead of selling the whole company. So I think that's what trickles down into that, is the thinking from other parts of the how they work with other portfolio companies. We talked about The Outsiders. John Malone has a chapter there, and you can look at John Malone influenced companies today. That would be an example. I'm not saying that I like every John Malone company and what they do, but if you were looking for what I think is an intelligent use of debt, I think you're more likely to find that among those kinds of companies. And I don't think that non-investment grade credit necessarily means that you shouldn't be using it. But I do think that things need to be used in an intelligent way for creating value. and that they need to be structured the right way. Many companies have debt because they need it in some form, or more accurately, they felt they needed it to grow. A lot of it is very short term, and a lot of it is also the companies are not highly liquid in terms of what things they have on their balance sheet offsetting that. So their current position is sometimes quite weak and everything. So I do worry about that. I also always say to investors who say they like the leverage, like, you know, like Hostess was a public company, remember? Mm-hmm. And people would say, oh, I like the leverage on and stuff. I'd be like, look, if you want, you can leverage safe, low beta stocks yourself if that's really what you're into. If you like that this thing bounces around a lot, you could always apply leverage to something in your portfolio. I'm not recommending it, but sometimes it seems like people like they want to own the Johnson & Johnsons of the world, but they want them to move a bit more. And what that really means is you want to own them on margin or something is what they're really saying. But when the company does it, it's fine, but I would never do it myself. It's not as dramatically different as you might think. The same thing if you used like leaps or things like that. So sometimes I think people like the idea of owning good companies, but they like the, whatever we want to call it, the more exciting gambling, whatever aspect of it that leverage provides. So I worry about that a lot. But for companies where it makes sense, I like it. And usually that is super rare in microcaps because you need some sort of like financially oriented person. Maybe they're a second career, maybe, something else like that. You don't see it naturally occur, I would say, that often in things like microcaps. I see a lot of, I mentioned the John Malone thing because there's very, very few examples I can think of companies, especially very small companies, where them doing a lot of extraordinary events, a lot of issuing stock, buying back stock, putting on debt, paying special dividends, whatever, is being done, and it's smart. The more transactions you see like of that, usually the worse the company is. Mm-hmm. And you're seeing a lot of at the market offerings or whatever things, a lot of dilutive things. They may be telling you that it's really good stuff that they're doing. That's their spin on it. But when you look at the numbers, I don't see it. So you just see more of a promoter type aspect to it than a long-term owner. Having said that, if you look at the history of Berkshire Hathaway, it was a tiny, not by today's standards, it wouldn't be a microcap if you adjusted for inflation stuff, but it was highly liquid and not on things that people would have found easy to trade. And it was doing all sorts of things. It did it borrowing at 8% and doing this and that in the first few years, buying things and everything. And it was all very smart, right? And we talked about John Malone and TCI and all that. That was obviously very junk credit. The other side of it too, which I've mentioned before, is there's all these factor things that include like the beta. People talk about low volatility things. I've always thought that you could replace that to a significant extent if you had an ability to understand the credit risk of a company. I do think that companies that are perceived to have very low credit risk, the stocks, do trade higher than stocks that are perceived to have very high credit risk. The way that works with the market, though, tends to be pretty fast. The market gets worried about it, seems to focus on that when they're so high, they're so great credits that they're like AAA type stuff, and they realize this and readjust, and that they're things that are on the verge of being ready to be headed for a real liquidity crunch. They don't seem to worry about small amounts. So I do notice that the market, I don't think, gives enough credit to a company that has 1 times EBITDA in net cash and doesn't punish a company enough for having 1 times EBITDA in debt. What it starts to worry about is when it's up there at 5 times or something, when there's a big pile of cash. It doesn't notice 5% of the market cap's in cash and notices 25%. It doesn't notice 1 times debt to EBITDA, but it gets real worried at 5. And so it happens quickly that way. And I would separate the quality of the business from the quality of the credit quality, right? So stocks, often people write about them as if they're junky because they are in the possibility of danger of bankruptcy, dilution, whatever, because they have a lot of debt. And companies that have beautiful balance sheets, they write about it as if they're great. But the business and the corporation are kind of 2 separate things. You can have a really high quality business that's choking on too much debt, and you can have a really low quality business that, because of its past, is really well capitalized and has no danger of ever heading towards bankruptcy or anything.
What are your thoughts on debt deleveraging stories?
Generally don't like them as much, just because I feel the returns that you get from them are usually pretty low in terms of the use of paying down the debt.
Mm-hmm.
But there could be ones that are exciting if the price is really low, right? Personally, if I was picking a part of the cycle to be in, I would rather be in the stock that can have debt and doesn't yet, and it adds the debt while I'm invested in it, than the company that has a lot of debt and now says it's going to pay it down. Now, that might change in the future, but debt has been quite cheap. And so I've not been investing in companies where I think the returns inside the business or from buying back the stock would be worse than the returns that you could get from paying down debt, right? Because you have to consider, when you pay down debt, there's a tax aspect to it and other things. But even today, even if it's pretty expensive debt, if you have like an better than about 8% after tax in cash investment opportunity, it probably makes more sense to do that than to pay down the debt. Now, it may make total sense to pay down the debt for safety purposes, especially if there's a chunk of it coming due sometime soon. What I'm saying is almost more if you imagine like a very long-term term loan, and so there's no bigger maturity upcoming or something like that. Equalizing it as if it's perpetual debt, we're thinking about it, versus like perpetual projects that you could invest in. But it's hard to come up with answers that paying down debt actually makes more sense than like buying back stock in a really good business, or certainly what companies claim they get in terms of EBITDA payback periods and all of that. But that might be changing, it could change. Like on the very short term, it looks like it, but still, we're talking about longer term things if you look at the yield curve and stuff that aren't unusually high. So I don't like them as much usually, but sometimes they can work out because they're so cheap, right? If people thought this thing was going to go to zero or something, the common,
Sure.
Then sometimes it can take a while for them to recover from that. And so people can just see this much debt and not be happy about it. But in general, I would prefer the opposite. I would prefer that there not be debt, but they're telling me that they're willing to put debt on. That would be much more exciting to me than there is debt and we're going to pay it down.
Would you think about debt on like an energy company differently than you would think about debt on like a entertainment business, right? We just spoke about movie theaters. Do you think those are two separate things entirely?
A little bit, but it depends more than I would have guessed about the people running it and their thinking. You would think that, I've invested now somewhat in energy things, oil and natural gas and other things. And it has been a bigger factor what the capital allocation attitudes of the people running it are than what the cycle of prices are. It has been bigger that way than I would have thought. And you could have predicted that ahead of time in terms of their behavior and how they talk. So I'm not saying that it's 100%, but it might be more like 50-50 who is managing capital allocation and what industry they're in, rather than 100% what industry they're in. So it's true that a more predictable, say, entertainment thing is probably someplace you feel safer in terms of them being able to make predictions, right? Tom Murphy would not have had the returns that he did, or probably John Malone, if they hadn't been in industries that were more predictable that way. Owning media stuff, it's a lot easier to know how much debt to put on something, how quickly you can pay down and everything, than if you're having to say, well, in this projection, is oil going to be $90 a barrel or
Sure.
$40 in year 3?
Mm-hmm.
Yeah, you can't pay down debt if that happens, right? Whereas he doesn't need to know that much what the advertising market is going to be to know that he can pay this debt down when he acquires a station within 3 or 4 years or whatever. So yes, but I'd say it's at most 50-50. I still think that who is making the decisions is as important as the industry, is what I've learned.
Mm-hmm. Mm-hmm. What's the most leveraged company you've ever invested in off the top of your head? Is there anything you could think of?
I've invested in financial services things, so in theory, depending on how you count the leverage, they're by far the most leveraged ever. They would otherwise would be Weight Watchers,
Okay.
which was controlled by a private equity thing, basically. Yeah. And the stock almost went to zero and could have gone into bankruptcy if it had been a different kind of time in terms of financial market stuff. Now, it went from probably $35 to $4 to $100 back down to like $4 or something. But so
you traded
yes,
it
you
each
also
way, right? You shorted it on the way down, rebought it on the way up. Yeah, got it. Yeah.
So you also could have made there's some people I'm sure who, I mean, I know people who made 10 times their money in it.
Yeah.
Buying after I did and selling after I did. And there you could have lost everything in it basically, because I do know people who had that experience. That's a combination there though. So what happened was that was a highly operationally leveraged company, but very, very predictable. So historically it had been very predictable, but it had these very high operating margins, sort of like if you want to think about it like a daily newspaper or something, right? Say you had a lot of leverage on that and then something changes. That's exactly what happened. So it's not even called Weight Watchers anymore. The company's now goes by WW International, and you also would have to go so far back in terms of years to see what I'm talking about. You can't see the good years anymore. But if you look, it had probably, I guess you could see a little bit 2014, 2015. That's when it's having the problems is then already. But you can see that well, you can go to the cash flow statement. That might help. So if we look back, what was cash flow in, let's say, 2014 or 2015?
$232 million. Was
okay,
in 2014,
then what was the next year?
2015 was $55 million. 2016, $119 million. Yeah.
Yeah. Now, one thing you can see, right, is that if this company had never, so basically a private equity type fund took it over, it was kind of the original thing, I guess it was a sort of carve out, spin out, whatever from Heinz or something. It had a corporate owner at one point. And then it was basically almost half owned by a fund. And they made payouts several times of like they buy back stock. I don't know if they kept the proportional interest, which would be like a dividend to them if they did. But they would like put on a lot of leverage and buy back stock. There's a few issues that I had with it. One, because they came from a private equity type background, they were very indiscriminate about the stock price. So they saw it as leveraging up, and buying back the stock is just to add leverage to it to improve the capital structure in terms of optimizing it, not worrying about whether you're paying $80 a share or $40 a share, right? You just do it because you want to add leverage. And then the other thing is, it is true, we can see what debt does to a company. Truthfully, so you want to look at the stock? If you look here, you can see where I'm talking about, where it went from, so what year is that?
So it had a previous high of 2011, and then it looks like the low was 2015. Yeah.
Okay. But then after that, it went to an all-time new high, right?
Yeah, it went from about $4 to, $100.
So if you want to be in really leveraged things, here's the thing. It was both operationally leveraged and financially leveraged. Yeah. So it is true, though, that this company would not, as much as people are say, oh, things change. And now, of course, you have these weight loss drugs, and that's why people expect it to be out of business. But it actually would, as a stock, without applying high amounts to debt to it, it would never go broke. Because even if you just look at the business really doesn't tie up capital in it, and it has good cash generation such that cash flow from operations is virtually always positive. As a rule, I would say, and I know everyone uses EBITDA, but I would say you want to be much more careful putting debt on any company that ever has negative cash flow from operations than you do a company that even in the worst years has positive cash flow from operations. Generating cash flow from operations is really the most important thing for being able to make payments on debt and everything. And then also there's the structure of it and all of that. But this stock was always extremely volatile that way.
Mm-hmm.
It also doesn't really have recurring revenue exactly, which is a bit of a problem. So it would spend very high on marketing to bring people in, but they churn fast. Now they churn slower on Weight Watchers than they did with any other thing, but all diet things, all weight loss things churn at very high rates. So, and all fitness things too. People don't actually keep gym memberships for long. So they churn no matter what. It's not, you're better off in a business where you're selling junk food and cigarettes and booze and stuff, because people don't churn on that stuff. They keep using those things. Whereas if you have gyms and weight loss things, they churn off of those. If there's a recession or something, people quit the gym and take up smoking again, and so they don't reverse that, right? So there's always a problem that people churn too fast. So they might go for 9 months or something on this program and then quit. And so that means you have to spend a lot of money to bring them in next time. So that was part of the problem too. Obviously, it could work out very well if you had, if it had improved back to the state that it was before and had a lot of leverage, and then it gets worse if it didn't. And I would say of those things, the most important one was the lack of recurring revenue, that you are investing in something that is very hard to sell, that people generally, I think it's good to be in a product that people use even if they don't necessarily have high good feelings about it and stuff, rather than a product where people is more aspirational, where people say they use it and they don't, and so lack of recurring revenue, I think, is a huge factor there.
Mm-hmm. Are there any other things or anything that you think, as it relates to microcaps, people should be aware of or think about as it comes to leverage on those businesses?
Well, recurring revenue, like I said, is very, very important, and there's very few microcaps that have high amounts of recurring revenue. Now, something like Nathan's, which you mentioned, does, but most don't. So that's one of the biggest problems. And then the other problem is that it's kind of mixed. You often have owners who are like either the people who took the company public in some cases, but often someone who's like owner-operator. And sometimes that means that their operation stuff is focused on the business that they came from, which may not have that much of a financial aspect to it that they're focused on. And so they're less likely to run them in a way like that. I think it is companies that were at one time owned by private equity or something like that are more likely to have that kind of behavior. So someone who was in the company that was involved in a small transaction that was financial and is still public, or then went public again or something, is much more likely the thing that you would see this kind of thing in than like a family business that does this. Because what they'll do is it's not that they won't put leverage on it, but they'll put leverage on it buying you out, and they stay on as management. There'd be a management buyout. It's not that small companies don't put on leverage. They just don't put on leverage as like tiny companies that stay public and do smart things. They'll just do it for themselves,
Mm-hmm. Mm-hmm. Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us. If you have a question that we can pull for the podcast, just like we did for this episode, email it to me at andrew@focusedcompounding.com. Be sure to hit that subscribe button wherever you are listening or watching us here today. And of course, if you're interested in learning about our money management services, reach out to me at andrew@focusedcompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.